So I think we've heard the word securitization maybe more in the last day and a half than any other term. It's where this industry is heading. I mean, it's not going to become 100% of the industry by any means, but we have started down this path, and we wanted to really explore this in a bit more depth. So we have the online securitization panel right now, and it is going to be moderated by Sam Hugh, who is an attorney at Chapman and Cutler in New York. So over to you, Sam.
All right, so good afternoon. I think this is the second last session, so thanks for everybody for sticking around. My name is Sam Hugh. I'm an attorney with the law firm of Chapman and Cutler. Focus on finance, that's the law firm. We personally involved in the asset securitization space for me personally for over 8 years now. To think I was at LendIt last year and basically learning P2P 101, and 1 year later we're talking about securitization of online assets. I think that's reflective of the growth trajectory of this industry. And so I'll just let the fellow panelists introduce themselves really quickly here.
Sure, I'm Eric Rapp. I work at DBRS and focus on esoteric ABS assets, such as On Deck, which we recently rated.
John Barlow, founder and CEO of Eaglewood Capital Management. We led or closed the first securitization of peer-to-peer loans in the fall of last year.
Hi, Zhenyuan Liu. I'm from On Deck. I run the capital markets and marketplace for On Deck. On Deck is an online lender to small businesses, and we have put lended to small businesses over $1 billion, and we just recently finished our first rated securitization in the space, and we also run marketplace where an investor can purchase whole loans from us.
Great. I'm Dave Petrowski, Managing Director at Waterford Capital. We're an investment banking firm specialized in structured finance. We worked with Eaglewood Capital to arrange their credit facilities as well as their term securitization.
And I'm Larry Shavaro. I'm the Executive Vice President of First Associates. We are the fastest growing loan and lease servicer in the United States with about $7 billion that we service. We're very active in the peer-to-peer space and active with John's securitization at Eaglewood, and have about, I think, 35 clients here in the peer-to-peer space at the conference.
All right, great, thanks. So it's because we're at a peer-to-peer lending conference, it's maybe not clear to everybody exactly what is asset securitization. So we're going to ask John here just to give a 1-minute overview of asset securitization and run through the history of asset securitization.
Yeah, sure, great. So the securitization market was really founded in the late 1960s as a means of enabling banks to gain liquidity on their mortgage portfolios. In the decades that followed, a number of other asset classes and collateral types were included in the securitization markets until you had a $1 trillion plus market pre-credit crisis. The market really dried up in 2008 and 2009, but in the last couple of years has really started to come back and enabled issuers such as ourselves to, first-time issuers such as ourselves to gain access to the market again. Securitization 101, you have an issuer or an aggregator of assets that assembles a pool of loans or other generally income-producing assets and creates a vehicle. You can call it a special purpose vehicle or a number of other names, which issues securities that are collateralized by that underlying pool of assets, and that's basic securitization. For us at Eaglewood, it's really just another means of getting leverage on our assets. We don't actually offload assets through securitization, but get financing against them.
All right. So thanks, John. So a few questions that we have here. I'm going to direct this to Eric and John, but anybody else chime in afterwards. I think we're all here because we believe that P2P lending and online lending really helps facilitate the origination of loans. And so the platforms are out there because they can access the borrowers and they can originate loans really quickly. Those in the securitization industry, we believe that securitization helps distribute risk, allocate capital effectively. So my question is, are we really just creating with securitization an originate to distribute issue that kind of was one of the main reasons that caused the mortgage crisis? So.
Do you want to start?
I'll let you.
All right. I think there's definitely a concern at the rating agencies around origination to distribute. You know, I'm sure a lot of you in the space remember the 08-09 meltdown and names like New Century and Countrywide that were indeed originate to distribute, and we know how well that turned out. I'd say as a result, that's not the only reason, but there's a definite concern with investors in the rating agencies that people are originating solid, consistent product, and they have skin in the game. You know, the ability to honor reps and warranties. You know, they're in it for the long haul. You know, there's kind of a joke, you don't rate two guys in a Bloomberg, you know, and it's most definitely true. So yeah, we definitely have a cautious view. I mean, on deck we are comfortable with because it's not originate to distribute. You know, they have a lot of new technology, but to us it's basically a specialty lender, you know, using new technology. But it's a balance sheet, it's underwriting, you know, it's servicing, it's vertically integrated, if you will.
Yeah, I think it's interesting from on deck's point of view. I mean, you know, getting the first transaction that's rated in our space. You know, I mean, Sam mentioned everybody's here because this is a very big growth sector. You know, growth sector is a great word for the equity investor and probably for most investors here. Growth sector is a pretty scary word to fixed income investors and especially guys like Eric, right? So, you know, I think especially in the lending business, what you need to be able to do is demonstrate that you can grow and you can control credit and control losses, right? It's very easy I mean, any of us can just go down the street and start handing out $100 bills, and you know, if they don't ever come back, it doesn't do anybody any good. So what's on deck has been really pioneered in is really be able to control growth and really grow at 150% year over year and lower our loss rates and learn from the data and learn from the performance history that we have experienced. And I think that's really a critical component of it. And the other thing I think for our industry, what's also interesting is that, you know, the prior panel talked about big data. Everybody is talking about big data. There's a lot of data in the market. What you make of the data and whether that data is meaningful and whether your prediction based on those data come to fruition and the performance actually demonstrate what you think, how the portfolio is going to perform is an entirely different thing, right? So if you look at on deck, when we decided to do the securitization, market is tremendous. You can sell anything to anybody in this market, right? So we probably could have done an unrated securitization very, very easily. One of the major reasons that we wanted to do a rated transaction is, you know, I think anybody will tell you, you know, having a rating agency in your shop for 5 to 6 months, going through your data, going through your operation, and look, you know, coming in and sort of, they're used to, you know, Eric will say this, like they're used to see bank and specialty finance companies, how the credit process is structured, how the portfolio management process is structured, right? And now they come into our shop, which is very much a technology-driven shop, using a lot of data. We have all the components and controls of credit and portfolio management, yet it looks and feels very differently, right? And we really should have gotten rid of the ping pong table at the shop because it's not rating agency friendly. So I think being able to demonstrate that and being able to go to the market and say, hey, DBRS came into our shop, a lot of fixed income insurance company came into our shop, did a lot of work, looked at our data, looked at our performance histories, and being able to tie back into the data we produced 2 years ago, 3 years ago, and actually performed, I think is a validation to our credit model and credit IP that we have put together over the years.
So John, why don't you respond to that? Because your securitization was not rated. We've seen S&P's recent release about potential inability to rate P2P loan securitizations for the foreseeable future. Yet I know that you're still planning on kind of pursuing this as a funding source. You know, why? How do you differentiate yourself?
Yeah. So just taking a step back, we created a fund, a limited partnership, a couple of years ago. Really for the purpose of investing in peer-to-peer loans with leverage. And historically, we primarily relied upon a warehouse line of credit provided initially by Capital One to assemble our portfolio. And we've never felt that we are reliant on securitization takeouts to sustain our business model. We have ample warehouse capacity. We're comfortable using that capacity, but we will securitize opportunistically when it is advantageous to our limited partners to do so. Through the securitization market and through our first securitization, we were able to eliminate a number of financial covenants. It was a covenant-light transaction. We lowered our cost of debt. We were able to get perfect matching of our assets and liabilities. We fixed our rate of interest versus the floating rate that we pay on a warehouse line, which is typical for warehouse lines. And so it was a non-rated transaction, and yet, from what I can see, we got all of the benefits of a rated deal without having to spend 6 months with DBRS or another rating firm, and several $100,000. So for us, it was advantageous to go the non-rated route. I've said in the past and will reiterate that we are not interested in being the first issuer to do a rated deal in the peer-to-peer market. We'd really like someone else to pave the path, and if it takes them 6 months, it'll take us 2 weeks once they've sort of paved the path for us. But I'll point out that the securitization that we completed had around 3 times leverage embedded in it, 75% advance rate. That is far lower than where you see most auto securitizations in today's market. It is far lower than what you see in the CLO market, and really is a far cry from what we saw pre-crisis with mortgage securitizations in terms of leverage. And so we feel, even though you could call our model an originate to distribute model, we've mitigated that in many ways through enhancement and over-collateralization.
And so Sam, so John makes an interesting point here, because the economics are not that far off between a rated securitization and unrated securitization, and both are similarly structured at this point. And so with the demand where it is today for assets in the space, you have to weigh the economics and the cost associated with that in order to see what works best for you there.
Yeah, I would add to that I mean, the structural aspect of a non-rated securitization is really no different than a rated securitization. We go through the exact same bankruptcy and legal structure. The analysis from the investors is the same. There's probably more scrutiny put on the originator, servicer, asset manager, because there's not a rating agency overseeing the issue. But from an investor perspective, they continue to get the same protections, and in certain cases can get even more, especially if it's a negotiated transaction where that investor has a direct impact on the negotiation of the legal documents.
So let me add something to that. I mean, I think I agree with a lot of what John and Larry and are saying, but I think one distinction you have to draw in this market is the following, and I think people use securitization for very different purposes, right? If I'm a hedge fund, what I really care about using securitization market, that's a leverage trade, right? How can I buy assets and fund my assets and get leverage cheaper so my equity is worth a lot more, right? On deck, as an issuer, as an originator, as an online platform in the market, I think the objective is very, very different, right? So for us to access the securitization market, it's not just about lower cost of fund. I mean, that's a given, right? So whenever you move from assets to bank balance sheet to security market, by definition, you're moving down the cost of fund chain, right? But what's also equally as important to on deck is we wanted to build a wide, diverse portfolio of investors who's gonna be there in the long run, right? I'm probably older than most people in the tech space, and you know what? I mean, Eric just said it wasn't that long ago when the market was dried up, right? So what was really important to on deck when we got into the securitization market is we really wanted multiple institutions to participate in our transaction. So if you look at the transaction in the market, it was well oversubscribed. We had 20 investors participate in our investment grade charge and below investment grade charge. And we talk about large insurance companies, mutual funds, banks, money managers, hedge funds, right? And those are the guys who did their homeworks and participated in our transaction. We probably could push the market a lot harder and got even better executions, but it's very important to on deck to get a wide distribution of the investor base. And what we also had created, if you think about it, is that through marketplace you can buy whole loans, right? And through securitization, you can choose to buy investment grade bonds or below investment grade bonds, right? What effectively we have created is people can get exposure in short-term working capital, small business asset class, and you get to choose the level of risk that you would like to take in on deck, and that's a very critical thing for us to do in this market.
So we're going to change gears a little bit here. Securitization, of course, we focus on what the underlying assets are, whether they're student loans, commercial, consumer loans, small business loans. A key aspect of any securitization is the servicing. The money still needs to get from the underlying credits to the investors. So I'm going to ask, Larry, can you kind of address some of the key considerations for what investors should look at when they're evaluating the servicing aspect of a platform?
Well, it's interesting you mentioned that because yesterday's institutional investor panel had a lot of conversation and dialogue around this, and they didn't really address it. And so typically today in securitization or a warehousing facility, there is a servicer, which is typically the originator, and then there's a backup servicer, which are companies like ourselves. And so we'll talk about Prosper for a second. And so Prosper recently decided that they were going to go out to the market. They have some warehousing and got some equity from BlackRock and others. And so they needed somebody behind their servicing operation to become a backup servicer. So we built and I hate using the terms hot, warm, and cold, because those are terms that were created by some of the rating agency guys, not you, Eric, but guys many, many years ago. And so we created, for better terms, a hot backup with Prosper, where we tapped into the co-location of their data, and we have live data at any time that we need it from Prosper. And so then we took that spoke, and around that the hub and spoke concept, we provided the institutional investors with a level of backup servicing and comfort where if there was a default or trigger event by Prosper, that we'd be able to come in 2 to 3 days and take over the servicing of the portfolio. And so standard, if you go back to your cold, warm, and hot, is typically 30 days to turn the portfolio. But the issue is, in 30 days from now, it interrupts the cash flow and the protection's not there. And so we created this mechanism in order to do that, and I think we structured about 15 transactions around that. Well, we do something similar with Lending Club and John's group here, and so that if there was a situation at Lending Club and there was a default, that we would come in and rescue those assets for John to protect the cash flow of the situation there. And so we do that quite well on many assets, not only peer-to-peer, but other assets today as well.
You have to keep in mind the general premise behind a securitization is to isolate the assets from the operational risk of the originator and the servicer, which is why the assets get transferred down into a bankruptcy remote special purpose entity, which is also why we employ a backup servicer. If Lending Club, On Deck, or Prosper, or any issuer was investment grade rated, you'd have a lot less risk at the servicer. But with a non-rated servicer, we like to bring in an unaffiliated third party to provide the backup, because those investors who are buying those bonds are not making a financial. They don't want to take the financial risk of the originator. They want to look to the assets to get repaid. And in the event of a bankruptcy of the servicer, these assets are short-term, a 3-year term. You need to be able to transfer that servicing very quickly, and within 30 days or even quicker than that, get the servicing transferred over, because you let a consumer off the hook for making a payment, good luck trying to find them.
Yeah, and the other protections around that are, typically people say, well, backup servicing is a great business, you don't do anything. I kind of disagree. We actually take the reports that are provided by the originator or the servicer at that point. Typically it's the same group. and then we spread those reports and validate all of the data versus their reports to make sure they tie out. And so if we see a jump in delinquencies, if we see that the cash flows aren't there, we will not provide the certification at that point back to their leverage lender, whether it's a Cap One or a Citibank or a Cap Source at that point. And so now you have a little bit of an issue between the originator and their leverage provider, and it kind of brings up a red flag there.
Let me add one point. At least from a rated securitization, for a new asset class like these and a first-time issuer, to get rated, any rating agency is going to want it to be warm to hot. You know, so if anyone's thinking of securitizing, you got to think about backup servicing. It's non-negotiable. And you tell me, but I think most of the private market deals are going to have something. You know, like, no one's going to give you. We like your businesses, but no one's going to give you capital and want to take risk on operating risk on an unrated venture-backed entity. You know, I hate to say it, but for rating agencies, it's kind of where hope goes to die. You know, we have no upside. The world's always half empty. So we always assume you guys blow up and go away. And there's got to be someone there to step in quickly like Larry. So, you know, it's kind of a depressing thought, but, you know, in fixed income, it's all about the downside, right? We don't really care about growth. We'd rather 5% growth a year and that no more, because that's, you know, very, very safe and stable. So I couldn't stress that enough. Yeah, that perspective.
And pre-crisis, you had the trustees that would step up as the backup servicer because, again, the thought was they didn't do anything. The issue there was if there was a trigger event or a default, the Citibank or the U.S. Bank or Deutsche had no functions whatsoever to take over this asset and service it. And so now their senior management has said, hey, wait a minute here, this is something that, you know, we shouldn't be really involved in. And many times they'll outsource to folks like us and become, you know, utilize their rating on a rated transaction to sign on the paper and then outsource to people like us.
All right. So thanks. That was a great discussion on servicing. I just brought up a couple of the rated transactions, and as you will see, they do involve backup servicing arrangements. So I'm going to turn again to a different topic here. We were talking about securitization of P2P loans, for the most part, consumer loans. There are other comparables out there. There are securitizations of unsecured consumer credit. Springleaf printed last year, OneMain printed earlier this year. So I'm going to ask Dave to maybe highlight what are some of the relative value merits. All else being equal, duration, spread, why would somebody look at a securitization of P2P loans versus one of those other types of transactions that I referred to?
Right. So first, from an investor's perspective, you always look when there's a new asset class or a new issuer, you're looking for comparable transactions in the market to benchmark a new issuer off of. You know, when we brought the Eaglewood transaction to market, there really were very few comps. There are not very many unsecured consumer loan securitizations out there. There are two primary issuers in the market, Springleaf and OneMain, who basically run a very similar type business where they originate loans through retail branch locations. I think Springleaf has over 1,000 retail branch locations. Their product is more of a customer walks into the branch, takes out a loan, and then they are really beholden to renewals. There's a lot of renewal of those loans. Both Springleaf and OneMain, they securitize those transactions. From a comparable perspective, both the Eaglewood transaction and we'll take the OneMain, both had the same amount of credit enhancement to their senior class, 25%. Eaglewood is securitizing lending club loans that have a projected lifetime cumulative gross loss rate of around 5%, which basically the simple math is that losses could increase fivefold and the senior debt investor still gets repaid. The average, the maximum loan term's 3 years. You're looking at 700 FICO score on average. So prime borrower, very short duration. That's a very attractive asset to a fixed income investor. In the OneMain transaction, you've got a subprime borrower with a 640 weighted average FICO score with loans going out to 5 years with payments being made in these branch locations. But you've got OneMain, who's a subsidiary of Citi Holdings and has been in business 10 times longer than Lending Club or Prosper or On Deck, which gives investors some level of comfort. But from a credit enhancement perspective, their senior bonds only covered 3 times expected losses. So as a fixed income investor, if you can get paid a little bit higher interest rate, get more credit enhancement, and have a good story with a high credit quality borrower, that's a good trade for a fixed income investor. Now, if Springleaf and OneMain are doing $500 million, billion-dollar transactions, they get sold like hotcakes. There's huge demand for that product. There's just a different kind of analysis when you start to look at some of the P2P platforms, but the investor gets protected, and they have to, because it's a new asset class.
Eric, do you want to add anything from a ratings perspective? Both, of course, OneMain and Springleaf transactions.
Sure. I mean, I rated OneMain, or I was the lead analyst, so I would concur. I mean, it's a harder subprime borrower than traditionally peer-to-peer. On the flip side, the business has been around in various shapes and forms, probably 100 years. When we looked at the data, we looked at the last 10 years plus of monthly originations. We saw what happened through the Great Recession. They probably, oh boy, they took us to their corporate headquarters. We went through all 11 floors. I mean, it's a very deep organization, with lots of different credit and compliance. So you really know what you're getting. The operational risk is very well boxed. You've seen lots of history. There's clearly risk around it, but on the flip side, we know what it looks like through 08, 09, and 2010. In a certain sense with peer-to-peer, I like it intuitively, but we've not seen it through the horror show. I mean, some ways, thank God, but it's hard to know how bad it gets until you see it through a recession.
I mean, I think what I will add to that is through our whole marketing process for the securitization, I think it's good news for the entire industry, which is even fixed income, I think equity investor gets the story, gets the disruptiveness of this online lending space. But I think, the positive thing that one of the positive things that I took out of the roadshow is fixed income investor gets it as well, right? I mean, you're talking about, think about the transaction where we have large insurance company and mutual fund participate in the deal, and they took $10 million worth of bonds, and they did a lot of homework, they did a lot of credit work, they went through credit committee to get a new asset class approved. They wouldn't have done that if they didn't think that this secular trend of moving online and Lending Club, Prosper, On Deck is going to be here to stay, and it's going to be growing origination platform, and there's going to be a lot more assets that's coming out of that channel, and it's going to get securitized down the line. So I think that in a trend, I think that's a great news for our industry.
Well, it's interesting you mentioned that, because where peer-to-peer is now, it's very similar to solar, and so we're very active in the residential solar space. The first 2 securitizations were just completed, and we sit on the NREL SAP-C committee, the Solar Access to Public Capital, and trying to bring securitization and standardization to the space. And so the agencies have similar issues. Hey, it's a new asset class, and Eric's shaking his head. And what happens when the homeowner sells their home? What happens if the panels blow off the roof? And so there's similar issues there. I think the first 2 transactions were just completed by Solar City with Credit Suisse as the lead. And I think the spreads were quite tight on those transactions here. This asset we're seeing, I think, John, you've got, and Lou got much better spreads than the solar transactions that just went off, and new asset class as well.
But I think when you look at some of the charts that I've seen at this conference, and some of these charts are like the venture capital investor's dream. You look at the growth, and it's a stair step up. That scares the heck out of Eric and the rating agencies, because you've got a new finance company who's been in business for 5 to 10 years, who all they've been doing is growing, and that's a scary proposition for the rating agencies, and you have to be sure that the controls are in place. There's such scrutiny put on the underwriting and the servicing of these assets, and if On Deck or Lending Club or Prosper doesn't really stick to their underwriting policies to be able to back up that performance data, their access to the capital markets would be closed. I mean, the capital markets, it is the empirical data, the historical performance, and the underwriting of these assets is so critical. And so anyone who's setting up these new platforms, you have to capture that data, stick to the underwriting policy, because your access to capital markets is really garnered by that.
I mean, that's very well said. I mean, I think as a platform, we sort of gone through the whole, we were venture backed initially. We were borrowing from hedge funds at high teens, and throughout the years, as we build better data, as we build more consistent performance histories, now we're accessing the securitization market, at very, very attractive rates. And you know what? Ultimately, that's a credit story in the sense of if your credit IP doesn't work, if you're going to reach for the moon and not get the predictability of your data, then the fixed income market is not very forgiving. I mean, performance history takes you years to build and takes you a couple quarters to blow, and it's very, very. I mean, that's a very good point. Yeah.
All right. So last question, I'm going to ask all of you guys to put on kind of your thinking forward. What do you see as either the next asset that gets securitized, online originated asset that gets securitized, or what do you see as the next major development in this space? Do you think that there's going to be somebody like a monoline that comes in and puts a wrap on the top, on the senior piece, or do you think that even maybe go as far as a synthetic securitization of this asset class?
Start with me. That's a tough question. I'd rather talk about reps and warranties. I mean, we've rated on deck. We clearly, I'm comfortable with small business online lending. I'm not sure where peer-to-peer is going to come out. There's a lot of things I think we like about it. There's definitely a number of concerns. You want me to go through the concerns or do that another time?
If you want.
All right, let me just, I put these up here at the top, 1, 2, 3, 4 are kind of, in my mind, key issues on whether peer-to-peer or if and when it can securitizes. One, there's a concern around the consistency of the underwriting. Is there enough history? And then you're also trying to separate the credit decisioning platform from the guy who's ultimately buying it. We've already talked about the originate to distribute. I'm not sure if that works with the rating agencies at this point. It might be too early to tell. And there's also questions of, are they using the same box consistently? And there's also, there's some issues around, what's the word? Around are people getting picked off? They might have a good scoring system, but are some guys getting there faster than others? And so if we want to underwrite Jonathan, do we know he's doing at least as well as the average portfolio? It's hard to say at this point. We talked about servicing capabilities and backed up servicing. Another one is potential disclosure issues. I've talked to some of the origination platforms in peer-to-peer, and they don't always disclose all the key variables. I mean, I assume they do a good job in modeling them and it's in their score, but if they don't tell you the origination channel, what does that mean, right? Because I think if I've learned anything looking at unsecured consumer assets through the years is origination channel matters. You don't want to lend money to the guys who come to you. You want to lend money to the guys you go identify, because everything else held constant between those two guys. The guy you go find is going to outperform on average the guy that wants to come to you. So that's a variable that matters, for instance. I'm not sure how it's going to work out. And then also, this is a big one, actually, the last one. It's a technical issue, but representations and warranties. So if you do a securitization like Lou did, they probably had to write 35 to 40 representations and agree to honor them to buy back. So they said, look, everything we underwrite, and put in the trust will be performing. It's going to have filed UCCs. It's a long list. What does that really mean? It means if they screw something up and down the road they did something out of compliance with their reps and warranties, they have to buy it out of the trust. You guys have probably seen on Wall Street there's been billions of dollars of settlements against the banks around the mortgage-backed securities. That's really what they're settling for. They just, 05, 06, 07, they knew this stuff was crap and they securitized it anyway. And the government's come knocking on the door and saying, that $50 billion you securitized, you violated your reps and warranties, pay up. So, as we look at this issue, for someone to securitize in peer-to-peer, they're going to have a meaningful balance sheet, because you have to be able to honor the reps and warranties. It's not just a subordination. You have to have an ongoing business that has capital that's going to be able to back those down the road if and when they get hit. They usually don't get hit, but someone has to be there to back them.
By the way, when I go to sleep at night, that Eric's voice and the whole spiel actually just goes around in my head. No, I mean, I think from OnDeck's perspective, I think it's a couple of things. I think one, we're gonna continue to build a very hybrid model. I think a lot of folks here are pure P2P. I think we're always gonna be running a hybrid model of balance sheet and P2P. Through Marketplace, you can buy whole loans just like Lending Club, and through our securitization platform, you can buy different rated bonds. And I think it's important to create, create different level of risk tolerance and give sort of people a la carte choice in terms of what type of risk they want to take to get exposure in this asset class. The other thing is, I think, the more data on deck gets, the more customer that we're growing. We're learning a lot about there's a different product that could be cross-sold into that channel. Now that you have this customer, now you know here's a restaurant that's consistently paid you back, took second loan, third loan, and been a good customer. I think there are different products that we can be selling into that channel. But we're not rushing into it. Like most of the newer product that we're testing on deck using alternative data, we're balance sheet them. So we're funding them using equity. We're trying to learn more about it. We're trying to do it methodically to understand the credit risk that we're taking before we sort of getting more scale into that space. So I think you will see a lot more innovation that's coming out of on deck and out of this industry in general.
Anybody else? Next asset to be online originated asset to be securitized?
I don't know. I just wanted to tell you, I don't think there'll be any synthetic securitizations done. Post-crisis, things are much more plain vanilla, and the guys who were doing the asset-backed CDOs and the CDO squareds and all the things that blew up threefold over, those aren't coming back. So we'll. I don't expect to see any of that.
We see a. Everything is very rosy right now. Everybody's having a great conference, and we saw this in solar 2.5 years ago. And so there was a lot of VC money that came into the space, a lot of institutional money, a lot of tax equity money, and now there's consolidation. And so I think that's what we're going to see here in a couple of years. And we're in the middle of many new platforms and doing servicing, primary as well as backup. But there'll be a consolidation where there's a fight for the customer, and customer acquisition is going to be critical to driving growth. And as that narrows, you'll see some acquisitions.
Yeah, so just to answer your question about predictions on the next assets to be securitized, we are closing our second securitization in 2 days. So I think I can relatively confidently predict that we'll do the next one. We are actually upsizing our first transaction. We sold $40 million of asset-backed notes in the fall of last year, and we're upsizing that to $75 million, so an additional $35 million.
All right, so just so you all know, if you have any other questions for this panel, we're going to be going straight downstairs to Yosemite A, but we still have a few minutes here, so if there's anybody who has questions, please stand up and a microphone will be sent around. Did a great job of answering the questions. You'll join me in giving these guys a round of applause. Thanks.
Good job, Sam.